And we are live. Welcome, everyone, to the Milligan's Island live stream, where we bring in experts to talk about important subjects instead of having everybody live in fear, uncertainty, and dread. This week, we've got Blaine Richards. He is an investment expert, and he's going to talk to us all about what we should be doing as one year ends and another year begins. I would like to point out or say a few words about our sponsors before we get started. We are brought to you by Digital On Ramp WSI, your full service digital marketing company. We turn searchers into visitors, visitors into buyers, and buyers into lifelong clients. There's a contact down there in the description. Give us a call and get a free analysis of your business. We're also brought to you by PillowSonic. PillowSonic is a great way to enjoy audio content without disturbing your partner. You can stick it under your pillow, have a Bluetooth connection to your phone, and listen to podcasts, old radio programs, relaxing music, and anything else. Also, we're brought to you by Fun Gifts for Everyone. Some great family gifts are available at the site. Uh, so visit the link in the comments and pick yourself up something nice. And at that, we are ready to get started. So, Blaine, why don't you go ahead and give yourself an introduction and let everybody know who you are and why I thought it was so important to talk to you right before the year starts.
Marty, thank you for your time. So my name is Blaine Richards. I've been doing finance for a number of years. My background, I have degrees in education and political science. A lot of folks say, well, what does that have anything to do with finance? What we really do is we take a very educated approach to finance, and we take time out of our day to sit down with clients to educate them on the market, where they stand, and really where they need to be. And that's one of the reasons why you and I, are having this conversation today, Marty, is simply that there are a lot of questions surrounding where the market's going, where people's financial positions are, questions like crypto and those type of issues that we're going to be tackling today. So I'm thankful for this opportunity, and I look forward to sharing more here in the minutes to come. So uh, I think we're going to go ahead and start off with kind of a gut check, and anyone on this broadcast can easily Google this. The name is Phil Conley. And it was a situation where Mr. Conley allegedly was an individual that kind of talked to people and took their money, acted like he was a broker. And it's a serious thing that individuals understand who they're dealing with. And if there's ever a question, and this is particularly of interest to our senior citizens, uh, if you ever wonder who a broker is, and they come to and they approach you as an individual and say, I'm so and so with brokerage company so and so, and I think you should be doing this, this, and this for your money. I want to encourage you to write down a website. It's called brokercheck.org, and it's a federal government site. It will list the individuals that's certified to be talking about these type of issues, and actually list their licensing and what office they work out of. So before we even get started, I want to just let your viewers know that that's a service from the federal government, and it's a critical service because I don't want to see people taken advantage of. Because right now everyone's an expert, right, Marty? They're expert in everything because they have access to Google. And we know that in order to get things processed properly, to make sure folks know where they stand financially, you need those experts that's available to you. So brokercheck.org, look it up, type in any information about somebody for in terms of finance, and you'll be able to access that information. Also, of particular interest to everyone here, I want to stress this to everybody. There is no silver bullet to solving someone's financial questions. There's not one product out there that's universally applied to every individual. I know a lot of folks look at the crypto market and they say, well, if we put a whole lot of money in crypto, we could strike it rich. There's always that possibility, right? but there's also a lot of downside, a lot of risk to that. So as I discuss things, just know that this is going to be a universal approach, general education, and certainly some of your viewers have provided questions for us, and I'll be fielding those questions in a generic aspect. So I'm not going to be listing specific stocks or specific recommendations because I really feel that each individual person needs that attention so we can kind of assess where they are and kind of understand where they need to be. Does that make sense, Marty?
Yeah, you hit on two really important aspects that I really like to cover. One is the fact that I usually bring in experts to ask questions of, and we don't like the idea of having the argument from authority fallacy here. What we try to do is not we try to bring in people who are very experienced and really know what they're doing to give a comparison, so that when you're talking to somebody in your life, you have an expert that you can compare what they're talking to you about and really understand how to judge if an expert is helping you and educating you and helping you solve your problem versus pushing what they have available to them and making them money. So being able to evaluate experts and understand when they have your best interest at heart and when they're trying to take care of their customers versus when they're trying to make a quick buck off their customers is really important. And that's why this series I bring in people I know and trust so that we can actually demonstrate you know what a truly capable person looks like. And the second part is that a lot of the answers that are given, we all the it seems like it's a repeating refrain that you really need to speak to an expert yourself about your specific situation. And around here, what we because that's an answer so frequently, it seems like it wouldn't be very useful. But what we really like to cover is helping the person understand why it's a complex question and why they need to be speaking to an expert and the type of information that the expert should be giving them when they ask that question, not simply and if you've seen the series, and I'm sure you're really good at this, which is why you're here. It's We're not just going to say that's a complicated question, go ask an expert. It's going to be that's a complicated question, here's why, and this is why you need to talk to them and what you should be asking about. So yeah, those are really good points. Then I'll hand it
Exactly.
back to you.
Go ahead. And if I could just interject on that, we take a very client approach to things. We're not a cookie cutter company. We don't walk into things and just universally try to sell you products. I've sat across hundreds of kitchen tables with people and really dissected their finances. And for some people, I've looked at their current position. I say, you know what? You're in a great position. There's nothing that I can do, to get you in a better spot. Stay where you are. This is not something where I depend on the commission. I do this as a courtesy to a lot of folks. And so, like I said, I look forward to talking further. Marty, if you don't mind, I'm going to go ahead and share my screen and we're going to start rolling with this. Let's make sure that this is going.
There we go.
So, okay, so I like to compare our finances a lot to GPSs. We have them on our phones. Some folks who might be a little bit older have them on our dashboards, and some folks have them in their console of their car. And what we find a lot of times when we deal with finances for everybody universally, we can establish a destination point, right? We can determine that, client A and B, you want to set and have, X amount of money, by the time you're ready for retirement. So what does that look like? How do we get there? And you know that on a GPS, sometimes you have roadblocks and you have things that happen. We call that life, don't we, Marty? We call that those roadblocks in the road where we have to recalibrate. And that's what we do when we write our financial plans. We actually call it a financial GPS. And we have some flexibility in our plans and in our designs that says, what, down the road, if you're a young client, you have kids, well, how's that going to change the trajectory of where you need to go? And what type of changes and modifications are needed to get you to your end point. And so we like to keep a very open mind about our financial plans and the planning that we do. And naturally, everybody universally can can benefit from this type of a financial plan. Now, uh, you know, long term, we like to think about so many things long term, and that's one of our approaches to this is longevity in the market. I know a lot of folks who like to have savings accounts, that start off now. 3% is extremely generous in a savings account. Matter of fact, we haven't seen that for quite a few years. But this is an example as to, if you were to put $10,000 in an account, how would it take in a savings account at 3% to double its money? Well, you can see clearly, 24 years, you can double your money at a 3% rate, which really is not good. It's an underperformer, in contrast to what I'm going to show you next. Let's say we find you a middle term account where it's kind of a middle road. You're making about 6%. That money can double then, you see, every 12 years. And this is a just a basic concept of how money doubles.
Yeah, Blaine, you might want to step back and explain the rule of 72. I know a lot of
Yes.
people who are experienced probably know it, and I'm probably going to
Yeah.
do a show where I derive how you get to the rule of 72. It's
Yeah. So sure. So the rule of 72 just asks the question, how many years does it take for your money to double? And so you can see, you take 10% and you times it by the year and with the percentage rate, and you can actually access this on Google. It's fairly easy to do. But you can see, let me back it up here. So, at the 24-year mark, at 3% interest every year compounding, basically what you find is at that 24-year mark, your money doubles.
right. So
And
it's
then,
so you get that by taking 3%, dividing it into 72, and getting 24.
correct, yes, you do. And then you do the same as the percentages progress throughout time. As you can see with the 6%, your money doubles in at 12 years. And then when you start dipping your toes into kind of the stock market, where the S&P makes a certain amount of returns, you start to see that money exponentially double. And this is where longevity in the market really makes a difference. So it's why it's important to invest early. A lot of the times in our office we say, when's the best time to invest your money? Well, it was yesterday. When's the next best time to invest? Well, it's today. And you say, now, wait a minute. The market's at all time highs. And I'll be getting to that here in a little bit in the presentation. But this just kind of gives you kind of a broad, very rough, numbers as to how critical it is for you to get your money in early and take advantage of what they call compound interest. Okay. Now, a lot of folks, it's the Christmas season. We like to talk about debt. And a lot of folks do struggle with debt. I think about West Virginians and those folks in Maryland and Pennsylvania. There's that struggle where credit cards are, racking up. The pandemic, folks have lost their jobs. Well, part of our financial planning is we build a debt stacking program for individuals. And over time, we teach people to pay down some of their highest interest, credit cards. And then we compound that and we roll that money over and we slowly start paying down other things that are of lower interest rates. So basically, things start to collapse down over time. And as you can see in this example, when each debt's paid off, we roll that over and we pay double on or the original amount into what the next bill might be. It could be a credit card, it could be a car loan, depending on, some folks are so top heavy in their cars because of the pandemic, their interest rates are sky high, and that's really what we have to do when we sit across those kitchen tables. We assess interest rates, we assess where they are, and we kind of build this plan of debt stacking. Now, this is generic in design, but this kind of shows you the power as to where we are. Uh, Understand that without debt stacking, It would take 23 years to pay off this debt, everything that's there. But with debt stacking, what we find is it 14 years sooner, and you save potentially interest of $130,000. So you're paying off your bills 14 years sooner. You own your house. You're able to do these type of things, and that's kind of the value of setting down and building that financial, GPS and understanding where those roadblocks are. And that's kind of what we do here with this. Now, I like to talk about a financial house and getting your financial house in order. Being said it's Christmas time and we're about ready to get into a new year, I like to talk about this concept. And it's a basic in concept, Marty. Uh, everyone knows that the foundation of a home is the most critical aspect that you could have. And I like to call it income protection, which is life insurance. A lot of folks now don't even have life insurance, or they have life insurance through their employer, and they don't understand how the policy works. And that's something that I like to dissect when I talk to these clients. I like to take the time to analyze their policy. Potentially, we have something that might work for them. Maybe, maybe not. But that's where I take the time and I meet with the client and we look at their policies and we really do an analysis as to where they are. Then we set up the budget. We set up the emergency fund. And I like to say that the emergency fund is 3 to 6 months worth of savings in your savings account to where you can pay for those things like a broken transmission. A lot of folks are keeping their cars because they can't afford to buy new ones because of inflation and how things are working. We'll be talking about that in a few minutes. So the emergency fund becomes really an essential part of the budget process. And then once we understand what you need in that emergency fund, we build that debt program to help you accelerate and pay off those things. We actually start you off immediately with a retirement account. If you don't have a retirement account, or if you have retirement accounts from past employers, we analyze those and we say, okay, what is this going to look like if we get that money working for you? And so we build you a retirement portfolio out of that. College savings. Marty, it is so expensive to go to college. Some of the numbers are just astronomical. I like to think back when I went to school, showing my age, it was $1,000 a semester for tuition. I'm telling my age with that. It's staggering to see the families that are struggling with college, and just saying, where am I going to come up with $15,000 a semester to be able to send my kids to college? And what does that look like? But we kind of look at those and we build those into the financial planning and we kind of calculate where they need to be. And then finally, the kind of the roof is their other goals. And that's where we sit down with them and we say, you know what, client A, B, what does your retirement look like? What are some of your goals and your dreams? And we try to quantify that. And our best goal is to put a price tag on that and understand where they need to be. And so this is the financial house. And this, by the time I meet with clients, this can be across an initial 5 meetings. It could take up to 5 meetings for us, either through Zoom or through face to face, where we start to build this program for them, and then we revisit it. If they want to visit with me quarterly, if they want to visit with me annually, at a minimum, it's an annual thing that I set up where we meet with a client to understand where things have changed. Some people like meeting monthly, some people like to meet quarterly. But this is kind of where we stand, Marty, with our financial house that I like to build. And I know a lot of people have asked the question, well, is now a good time to be investing in the stock market? And I'm sure, and just looking at some of the questions that we have, there's a number of them that kind of ask that question. I'm going to show you a couple infographics to kind of show you where we're at. Now, you might have to zoom in on this, I'm not sure, but this is a recession risk indicator. And to kind of view where we currently are, and you can see for the past 3 months, consumers, business activity, financial, and the green arrows our expansions in those markets. In November, of course, December hasn't closed out yet, so we can't analyze that. You look at housing permits up, job sentiment. People are feeling good about their jobs because jobless claims are down, which makes that number go up. Retail sales are up, and really December looks like it's going to be a pretty strong month for retail sales as people take advantage of Christmas spending. Wage growth, there is a little bit of caution there. And we'll be talking about the Build Back Better plan and those type of things, how they impact things a little bit later. You can see that commodities, profit margins are up, trucking is up. So what does this mean? This means that everything indicates, and we can only look from a historical perspective, that things are on continue to be on the upswing. So recession, can it happen? Of course it can. But the indicators are showing that it's not pointing that way yet. Now, the next infographic I'm going to show you, let's compare it based off of prior recessions, because everyone is nervous about this. It's the number one topic right now in my meetings that I have with people is I'm afraid to invest my money because there's going to be a recession. Well, even dating back to the early 70s, you can see a lot of recession marks that's pointing towards that direction, that there's going to be a recession that happens. 2020, you can see there's a couple concerns. Economically with profit margins because of the pandemic, wage growth was a definite recession because folks lost their job during the pandemic. But now currently, you can see all of that is expanding. So what am I saying with this? I'm saying, is there a recession chance? Of course there is. The one thing I want to stress to everybody on this call, I will never guarantee a return. I will never say I can guarantee that there's not going to be a recession. We don't know what tomorrow brings, and anyone that says that does not understand market dynamics. But we can look from a reflective view to kind of understand where indicators do point. So what am I saying with this? I'm saying that the likelihood of a recession is smaller. The likelihood that the markets will continue to perform, you know, on averages, it's most likely. Now, what does this look like for our fourth quarter in 2021? We understand that the recession risks are below average. We know that the tailwinds are better off than what the headwinds are. We do know that business investment's up. So the U.S. economic outlook is looking really good. And how's the market looking? Well, you can see in our view, the sell-off is a buying opportunity because we have seen sometimes when the market's dipped. Those are buying opportunities for clients. And if some of those folks on this call are retail investors who invest in places like Robinhood, places like that, you know what buying the dip looks like, and you can understand that certainly. So overall, Marty, I have to say that the market looks good. There are some issues that's coming up though, and this is some themes that we have to look at looking into 2021. Inflation. Everyone wants to talk about that, and it is very high right now. We have not seen inflation like this since the early 80s, and potentially in some markets, in some sections of the market since the 70s. So that does, you have to calculate that in. For those folks that have money like in savings account, you do realize that when you're in a savings account that's making 0.01%, you're losing 6.8%, to the market because your dollar doesn't stretch nearly as far. So inflation is a concern as we look into 2021. Valuations. How long does this market continue to go up? We've seen it kind of stabilize and get a little bit, some normalcy. We just came out of a huge bull market, and arguably we're still there. Where's that look like? What does 2021 look like with the inflation rate? How does that affect the valuation of the market? Market leadership. There's a lot of questions marks about where the markets are going to go and who's going to head that up. You think about the interest rates and how the Federal Reserve is talking about increasing rates, into the first quarter of this year. What's that going to look like for the market? How's that going to impact people's portfolios? That's a very valid question. Internationally, supply chain issues, COVID, how does that affect things? It is very difficult for some folks to be able to get their Christmas presents. Either one, it's not being manufactured because of COVID, or two, it's held up in ports because of lack of workers potentially, or three, we don't have truckers to get things over. So internationally, how does that affect the market? And but the bottom line is, how does that affect your portfolio? That's a big question. Volatility. There's a if you look in if you can Google this, the volatility index, VIX. You can go into that and you can see, volatility. And what does that mean? That simply means how anxious are people about the market. And I will tell you, Marty, a lot of people are anxious. A lot of people are asking those questions. Should I be backing my money out of the stock market? Should I be putting it in a more safe haven? Should I be putting it into treasuries? Should I be putting it into bonds? There's a lot of those questions. Matter of fact, we're going to start into these questions here in a second, where we have to ask ourselves those questions. And the volatility. What does that look like? If you look on, you can do it .vix, you can see sentiments and how the markets kind of move with that. So I'm going to stop sharing real quick here. But I thought maybe we could start kind of getting into some of these questions. Marty, do you have anything for me before we start rolling into this?
No, I think that was a good overview of where we're looking at the market right now, and I think that I think there's a distinction between investing and trading, and that when we're preparing for retirement and we're thinking about investing, a lot of the short term things that we look at are probably less of a concern over the course of a 20 or 30-year investing career preparing for retirement. And we also need to realize that the average, we're as life expectancy extends, there's a good chance we're going to spend 20 or 30 years in retirement in addition to the 30 or 40 years we work. So, it's more important to have an investing strategy than it is to try to concentrate on what the market's doing at any one time.
Timing the market's one of the worst things you can do. Uh, don't try to do it. You kind of look from a historical perspective and understand where the market's going. And your retirement window is so important to understand. And being able to put yourself in a financial position to protect your assets once you get a little bit older in age, that's critical. When you're younger, you got a lot of time to grow. But when you get older your age, it's time to kind of reconsider things. So yeah, that's a good point.
Cool. Well, if it's all right with you, we've got there's not a long list of questions, but I think these could, I hope they won't take too long to get through, but let's just jump into them.
All right, let's go.
And again, as usual, I try to collect questions from around the web wherever I promote this, and then I consolidate them down into a few questions that make more sense. So I did that again. And the first question is a composite. It says, were there any changes to the tax and investment rules in 2021 that I should act on?
Um, Not really. And of course, I'm kind of old school. I have my notes here, so I might be peering down at my notes. But right off the top of my head, no, there's nothing that you should take action on except for the date, April 15th, 2022. That is the last day you can make contributions, and there are limits. So if you're 49 years of age and younger, the maximum you can contribute is $6,000. If you're 50 and older, you get an extra $1,000 bonus, so you can contribute $7,000 to your retirement accounts. That can be a big deal. It can be a big tax savings for you. If you're a business owner, even if you're an individual, you can lessen your tax burden, pay less in taxes by essentially putting money away for retirement. Now, down the road, you will be taxed on that money when you come out, but that's tax strategies that we can plan for on an individual basis.
All right, and how about upcoming changes for 2022? Is there anything there that we should be concerned about?
No, there's really not. The IRS, as far as we can tell, is not making any special changes to anything. It seems to be pretty much status quo. But if there is, I'll definitely send you an email, Marty, and let you know.
I know there's a lot of concern about pending changes, but nothing has actually gone into become law at this point. And I think that's important for people to realize that a lot of the concerns and the fretting they hear on the news are potential things, they're not reality. And to relax, pay attention to it, maybe write your Congress critter, do those kinds of things, but don't get too bent out of shape until it becomes real.
So we call this a legislative risk and a political risk, to where essentially some of these things coming through Congress does affect your wallet. And a lot of folks thinks that it only affects the rich. It doesn't. It really does affect retirement accounts, and how you're going to be able to spend your money when you get into your elder years. So please pay attention. I fully agree with that, Marty, 100%.
Great. The next question is something that man, I can't tell you how many times this came up. If my employer offers a 401k, can I still open an IRA?
Yeah, of course you can. Um, so there's an approach that generically we like to say. Uh, we always tell folks to take advantage of their employer's 401k up to the percentage that they match. So if your employer matches at 5%, then whatever that is for them, for you to match that amount, go ahead and invest that. Now, anything above that, like I've met a number of people that have like 12 to 13% going into their 401k, and their company only matches 2 to 3%. So what I say is, let's consider an external account. What we find in a lot of 401k plans is they're cookie cutter. They say, if you want to invest aggressively, moderately, or conservatively, you have three options. I know working for the federal government, we have like five that really makes sense. And it's really a cookie cutter approach, but you should take advantage of the matching. But then let's take that other amount that you're investing and let's allow you to control that. And then because what something that most brokerages offer is a broad, view of the market, and we can really hone in on your specific needs. So yes, you can definitely do that, and I highly encourage it.
And is there a limit to what you can put into your IRA total?
So there is, the limit would be, that $6,000. Now there are things that you can do outside of that, like you can do unqualified accounts. So don't think that just because you might meet a certain threshold, that you can't put it other places in unqualified accounts, because there's definitely different positions you can hold. So yes, there are certainly other avenues we can take.
And I guess the question would be: are there, depending on what your income is, can by switching between 401ks and IRAs, can you adjust the limits to what you can tax protect at any one time?
I believe that you're capped at the $7,000 and $6,000 marks between those, for those type of accounts.
Uh, cool. I knew that was the answer, but I wanted to hear it from you.
Yeah, yeah. So you are capped at that, but there's unqualified accounts that you can go to that offers some of those benefits, just not on the taxation side.
Yeah, that is probably an entire subject in and of itself. We should probably
Huge.
have you back on to talk about that.
Yes, it's very big.
Uh, Next question was: can I open an IRA if I didn't have income?
So you must have earned income to have an IRA. It must be earned. It can't be government assistance, anything like that. It has to be money that you have earned. Now, there is a small caveat to that. You can still put funds into a non-qualified account, but there again, you can't put money into something that where you get tax advantages when you don't have any income, and that's really what these 401k plans, IRA plans are meant to be, is to be those tax advantage plans. If you don't have any income, you can't take advantage of the tax breaks.
Is there anything there like a husband and wife can do? Say the husband has is working and the wife is staying home. Is there anything they can do for the wife at that point, or is it they pretty much stuck with the husband's limits?
It depends on, see, that gets kind of into some fine print. I'd really like to be able to look at their financial position to understand really where they're at. There could be, but that's something I have to talk to the individual about on that one.
Great. Can I still convert a traditional IRA to a Roth IRA?
Sure, you can. As a matter of fact, that's one of the biggest perks about drawing down and saving yourself a lot of money on taxes. We do Roth conversions, where, think about it this way: if you have $100,000 and you want to pull that money out, and it's in a qualified account, a 401k, and you want to pull that full $100,000 out, and you're taxed at a 25% rate, then you're losing $75,000. Or I'm sorry, you have $75,000. You're losing 25,000 in taxes. What Roth conversions allow us to do is every year pull a little bit of that out to keep your tax burden hopefully at a lower level, so you're not getting taxed. I have a calculator that I set down with my clients, and we figured out the mathematics behind that. Some clients have saved, $200,000 in their taxes over the duration of 10 years, being able to pull that money out slowly out of their 401k, putting it into a Roth, and only paying for what's withdrawn within that tax year. So we're not accelerating their tax rate where they're getting hit so hard with taxes. That's the biggest area of concern for folks that are getting closer to retirement. Is, we don't want to get hammered with taxes. What's the mechanism we use? It is Roth conversions. That's one of the best mechanisms we have.
We probably should take a minute and explain the difference between a traditional IRA and a Roth IRA in case
Yeah, sure.
we got a
So,
viewer popping in not knowing what that is.
yeah. So basically, best rule of thumb: a Roth account is money that you use after you're paid. It's money, like if you were to be a client A, you know, you have your money that gets taken out pre-tax into your 401k or into your IRA, right? That's money that goes, it's put in, and it becomes a tax deduction on your taxes for this calendar year. A Roth says, well, what's your gross? Whatever you gross, we pull money out of that, whether it be 5%. So if you make $1,000 a paycheck, we're going to pull $50 out of that and put it into a Roth. Now, when you retire and you pull that money out of a Roth account, you don't pay taxes because it's already been taxed at the tax rate of the year that you pull the money out of. So, basically pre tax, IRA, 401k, post tax, Roth account. So, for a lot of my clients, they love the Roth. And really, the Roth is really a good thing to be in, along with a 401k, but that's kind of the synopsis of it.
Yeah, and I think a lot of times people were making the assumption that they were going to be in a lower tax bracket in retirement, and I think we're finding that a lot of retirees are not seeing that in reality. When they retire, they're in just as high a tax bracket as when they're working, if not higher.
And a lot of times they sell real estate, and they want to move, and how all that impacts along with their withdrawals from the 401k. They find that they're in the highest tax bracket, where when they were working they're in that 22 and a half, 24%. Now we're into the 30s. How's that possible? So a Roth does make sense, and that's something we like to do in the financial planning session, over 4 or 5 visits, where we kind of understand that and educate the client on those issues.
Yeah, I think that was always probably a problematic assumption. Um, it only makes sense that if we're going to have, well, we've gone so parabolic in taxing higher incomes, that it's become much more evident. But the idea was always that older people have more assets and resources, and it's just that the tax man just bites harder the wealthier you are.
Sure does. Yep.
Next question has more to do with what's appropriate for putting in your retirement account. So the question was, what should I hold in my retirement account? Stocks, bonds, gold, crypto, real estate, etc. There's kind of went through the asset list and said, what's appropriate for retirement and what's not appropriate for being in my retirement account.
So this is one of my specialties, and this is something where that financial planning comes into such a big role into what we do. Crypto, a lot of people talk about crypto, and should that be something that we look into for retirement? I argue no, because crypto is something that's completely unregulated. I work in a regulated environment. That's not to say that crypto doesn't have its place, but when we're talking about retirement, the money that you want to save and have for your golden years, where you can pay to get your kids off to school or you can retire comfortably, crypto doesn't play a role in that, in my opinion. Now, for those brief little bursts, for the retail investors, sure. I always tell people with crypto, whatever you're willing to invest, you better be willing to take the money, put it in the trash can, and light it on fire. Because you just don't know. The crypto market is so unstable. You don't know. Doesn't mean there's not a place for it. It's just extremely wild. Now, there are spots for, gold, silver, and those type of assets. Those hedge off inflation. I'm a firm believer in holding mutual funds for retirement because there's so many options for those individuals that are in their retirement years, for those folks that are considering getting close to that retirement bubble, for new investors. I mean, there's a lot of emerging market mutual funds that we have that you can get into. I'm a firm believer in mutual funds just because it offers stability more so than investing into a general stock. Uh, we've all seen those stocks that, IPOs, they shoot up really high and then they drop right off, and you lose a significant amount of money. Some IPOs go up and stay up. Picking those individual stocks can be a challenge. Not saying it can't be done, but I like to look at more pooled assets like those mutual funds. Now there are real estate certainly is an option. It's not something that I specialize in. I'm not a real estate person. Not saying there's not a spot in the market for it. Not saying it's not in your portfolio. It's just not an area that I really specialize in. But yes, real estate assets, sure, 100%. You can invest in that. It's a good idea. It's just not an area of my expertise. So there's that.
Yeah, and I think that the what's right for your retirement isn't is kind of what's right with your knowledge. So somebody who doesn't have a lot of knowledge in a specific aspect probably should learn more about it before they get ready to move it into their retirement account. And I think that you know when you're getting started in retirement and building your nest egg, you really want to stick to the things that you understand and get some experience in. And later on, you can talk about selling some of that and buying gold or buying businesses or buying real estate in your retirement fund account once it's reached a certain level where it's got enough money where you can make those investments and actually be an accredited investor.
Yeah. So a perfect example is I'm not going to have a 25-year-old investing and buying businesses that only has $10,000 in a retirement account. That's just wrong on every level. But an accredited investor that has a couple million in their account, for retirement, real estate does come into play. And those type of things do come into play at that point. It's just a question of where you are at the stage of life and how best to play all these different aspects of the market to benefit the portfolio. So yeah, 100% agree, Marty.
Yeah, I do have one topic that I want to bring you back in at a later date. There's a strategy that I want to ask a lot more questions about that I just heard about, and it has more to do with because crypto taxes are so hard to figure out that it's a way of buying your crypto in a Roth account so that you can avoid the tax calculation. And there's a lot of downsides to that I want to try and bring you and maybe a couple other people in and have a roundtable discussion on that one strategy because it's just it's really complicated.
Yeah, that would be a very long video.
Well, I want to bring in a couple crypto guys, a couple retirement guys, and kind of bounce the idea off. And maybe bring an attorney in who specializes in calculating taxes for crypto. Because crypto tax calculation, in my opinion, is the one area that I've got you with crypto investing that nobody is addressing really well.
I agree. Yep.
Um, the next question we got was, can I open a retirement account for my newborn?
Yes. You can. It's called a minor retirement account. Yes, start off early. So yes, you can. We set those up. Any broker can do them universally. It is called a minor retirement account, and the person that opens it, which needs to be the mother or the father or the caregiver, they open it up in their name, their individual name, and basically the child is the beneficiary of that. And then when they turn 18, it is turned over to them 100% in their name, and really off to the races. So yes, 1 year old, 2 year old, do it. The best time to do it is now, and I sincerely mean that. Even with the market being as high as it is, I sincerely mean that. If they're 1 year old, or 2 years old, they have 60 years for something to grow. So yes, 100%. I buy into that. Highly recommend it.
Yeah, I did the math one time for my mom. I said if you really want to set somebody up, if the entire family can put together $5,000 in a retirement account for a newborn, that newborn is guaranteed to have a great life. They no longer have a retirement worry in their life.
Yep, 100%.
Is that product you mentioned? Is that a investment account or is that an insurance product?
That's an investment account. Yeah.
Okay, great. The next one, all the inflation talk. I got about 15 questions on inflation, and they all boiled down to one sentiment. It is, can I protect my retirement account from inflation?
Yes. Two angles to this. My answer is yes. If you're willing to put money where it needs to be, um, you can. There's certainly different mutual fund classes that will allow you to hedge off that inflation. If you're willing to take the chance at doing it, you can 100%. Now, some folks like to be very protective of their money. Those folks that are in their retirement years, there are tips that you can invest in that it's kind of it's literally a inflationary protection system that's in place that can protect them, those senior citizens in that situation. But yes, you can, and certainly you need to look at your portfolio, and you really need to consider where you are, and that's something we can help you with, and kind of determine where you need to go. But universally, yes, you can. You might want to take a little bit more risk than usual to help with that inflation. But and I don't want to say only looking at 6.8% because it is a large number. But in terms of the market where you could potentially be, certainly, that could be hedged against.
Yeah, and I was when I saw all those questions, I went and took a look at some history, and I think it's I don't know. I think the debate between was the inflation we saw this last year 100% due to the debt and the money printing, or how much is related to demand curve shift because of the constrained production, because of the response to the pandemic and disrupting the supply chain, and then giving access to a lot of dollars to support the folks who are thrown out of work. That kind of does a supply and demand curve shift, which isn't really the same thing as a traditional inflation where money creation is the root of it. There was money creation and keeping people employed and giving them out on the demand side. But I really don't think that at some point these supply chain shifts are going to be accounted for, and we're going to get back to a normal market. But we're still going to have to contend with all of the Cantillon effects of printing all that money, and it's going to take 2 or 3 years to move through the entire economy. I don't. It's the. I think the short term inflation to me is probably more attributable to supply and demand curve changes, and the inflation we're going to see in out years is probably going to be more related to the Cantillon effects of printing the money.
Yeah, so there's two factors that are in play, and you articulated it very well. Supply chain side, the demand for something. If something's not being produced, demand goes up, doesn't it? You know, if the market is flooded with something, and that means typically, and this is just pure economic theory, the price goes down. We're seeing that in real time right now with the supply chain, choking areas such as the ports, coronavirus. These issues are all out there. And then on the monetary side, with what the federal government's doing, general rule of thumb, and it's basic. I'm going to take a very basic approach to this. When the interest rates are zero with where they are now, there's a flood of money because banks, commercial lenders, those type of entities can borrow basically for nothing, and they ask for more money and more money and more money. And then stimulus came out, appropriately so, for so many people that needed it. That money went out, flooded the market. So there's a ton of this dollars. Trillions of dollars. I think I read one estimate between 10 and 12 trillion dollars were printed within the past 18 months. That's flooded the market. So we have all these dollars chasing so few products, and you see those inflationary numbers starting to increase now over time. And maybe another time I can come back and discuss inflation on more of a micro scale, and how it impacts us. But we are going to see in the next 3 years, we'll see inflation potentially go down over time, but it's not going to be a sudden drop. Everyone wants inflation just to go away. It's not going to. It's going to take 1, 2, 3 years, probably 3 years out there for those dollars to get basically bought back by the Fed, interest rates to go up, restrict the dollar to make it not so easy to lend, and then with the supply chain starting to come back online, we might start seeing that inflationary number get back to where it's at more comfortable 1.5%, 2% instead of the 6.5% we're dealing with right now.
Yeah, it's a really important to illustrate that it's not the same effect over time, and it really has to work its way through the economy. So, for example, now we've got these tight supply chains, and businesses are just not borrowing because there's not a lot for them to spend money on and make money on, and so there are the overall money borrowed by businesses is shrinking, whereas money borrowed by the government is expanding. But as this crisis works its way through, you're going to see the money borrowed by government will shrink a little bit, and money borrowed by businesses is going to start to expand again. And so you're going to see the money creation is going to move to different parts of the economy. And as this works through, we're going to see prices increase. We're going to see the money supply expand. And it's good for people to keep in mind that it just takes time for these effects to work their way through the entire economy, and they need to be patient as this is happening, and to make sure they put themselves in good financial positions, because it's really hard to predict what's going to happen to prices as this process plays itself out.
And one of the problems that I think the Federal Reserve is dealing with right now is how quickly do they act. We all know that when something happens fast, the market reacts fast. So I think the tampering off is what we're talking about doing with the Federal Reserve. Is that goal in mind? Is that more longevity and trying to get the dollar a little bit stable and trying to get a little bit less money out of the economy, and it is going to be that slow process. So, folks, it's not. This is going to be a long road. Just be ready for that long haul for sure.
Cool. We're a little bit of subject changed here. If I have a 401k loan and I am forced out due to the vaccine, I guess forced out of their job due to the vaccine, what can I do if I can't pay back my 401k loan?
So, in most cases, there's a loan in the 401k, and you separate from service. You have 60 days to repay the loan. Or when you roll the funds over into an IRA, the amount would just be less the loan amount. So those are your options. If you don't pay the loan back, ultimately it's earned income. And a lot of people are getting kind of hung up on this. And that's where a good financial plan comes into play, to kind of see what can be done in that. I know a lot of people were hurting during the pandemic, and so that's just one of those things where we got to sit down, we got to determine where you're at right now, and then kind of determine what process we need to go through. But you do have that 68-day window to pay it back. A lot of folks can't. Totally get it. And then how do we plan, from that? Where do we go from there? So really, this is going to be one of those things where it's kind of on an individual basis. Let people sit down and have that conversation, because everyone's needs are different. So we need to kind of assess where that person would be.
Yeah, and I would, I've been talking to some other folks, coming up with resources on this. And some of the folks that I've been talking to are more in the mortgage business and in the banking business to try to put either home equity lines of credit or doing refinances while interest rates are low to get that money back and avoid the penalties and the taxes, because if you don't pay that loan back, that is considered income, and that could be a really big tax hit. Plus, it really drops the amount of money in your 401k down a lot. And taking out a home equity loan or refinancing at a lower rate might be a good way to cope with that. I mean, it's not preferable, but taking out the 401k loan in the first place is probably not preferable.
Yeah, so these folks are obviously were struggling with in their position wherever they might be, and certainly right now in this window when mortgage rates are pretty low, take advantage of it. Home equity, whatever you need to do, because here soon we're going to start seeing those numbers creep up. So yes, you do bring out a good point about potentially doing a refi or a home equity line of credit. Those can be in play. That's another tool in the tool bag of the financial planning.
Great. And we've made it all the way through to our last question. This is a long list. And I appreciate you coming in and playing Stump the Band. Whenever I put questions out, I don't know what I'm going to get. And man, everybody I brought in has been like, wow, those are a really long list of questions. So
Great questions.
the last one is, for the fixed income portion of my portfolio, what are the advantages of bonds over insurance products? And I guess that they're looking for, what's the comparison of bonds to insurance products, or
So broad answer here, okay? Because I don't know where this person's coming from. Broad answer. Insurance products. I like to think of annuities, just standard annuities, variable annuities. Uh, that's an option on the table. One thing that I will say about annuities, I've set up some in my day. You need to be very understanding, and this is part of the education component when I sit down with clients, understanding the surrender charges. If you pull money out early out of a annuity, then there are surrender charges that you have to face. Uh, the downfall of just a standard annuity is sometimes it does open you up to those inflationary risks that we're seeing right now. And folks say, well, what about a variable annuity? And a variable annuity is something that is a product that kind of invests in the stock market for you, and then you reap the benefits of an up market. And sometimes you reap the benefits of a downward market. It really isn't a benefit, it's really a detriment that you have. So that does open you up to market risk. So, and in terms of bonds, you also have to deal with inflationary risk involved with that as well. If you're locked into a bond over, 10 years, 20 years, 30 years, you're getting a set interest rate back on that. And so you're going to struggle if inflation is high. You're going to struggle making up that difference. So once again, it goes back to my original point when we first opened up this video, where we had that conversation. I believe there's no silver bullet to a portfolio. There's not that one thing that's going to fix it. What I would say is if a person is really concerned, about bonds and how they're structured is you consider like tax bonds, like your municipal bonds, and how they're taxed and what's the benefit of that. You consider corporate bonds, where you do get a higher percent where it sells at a premium, but you also open yourself up to the question of is this business going to be open and have its doors open for the duration of this bond? And then you have a question of government bonds. Well, we know the government's most likely going to be around, right? So, those interest rates, that they repay on those bonds are very low in percentages. And there again, federal policy has a direct influence on the bond market, specifically dealing with government bonds, and it does affect some of the other markets, but government bonds really do play off of the federal tune. So it all comes down to what does the client need? For some folks, those annuities are great because they're locking in X amount of dollars for X amount of time with a guaranteed amount of money coming back out. That money is set. And then 9 times out of 10, depending on how things are set up, they get that money returned to them. Or variable, you play the market. You do take advantage of swings. Or you do offer the bonds and really where those go. So it just depends on the client. At the bottom line, no silver bullet, no single approach for each individual person.
So there's really no solution, just trade-offs.
There really are. We like to think of using multiple uh, faucets of the market, based on age, based on position, because you're not going to stay you're not going to be aggressively invested when you're in your 60s, getting ready for retirement, are you? Probably not. 9 times out of 10, you're not. Nor will you be conservatively invested in your 20s. And as you age, there's different products on the market that are advantageous to your situation. The question is where are they applied? How much is applied? And that's where that financial plan comes in, into its fullness, is in those question marks. And that's what we're here to do. We're here to help you navigate those.
Yeah, it amazes me every time I talk to somebody who knows an awful lot about these complex topics. Is when I do business consulting, I always have a measure that I look for, which is the business relying on or over relying on one factor of production in their operations? Have they gone overly heavy on labor? Are they too reliant on debt? Are they using specific kinds of machines too much? And it really seems that when I start looking into these other complicated areas in life, like investing and planning for retirement, it's the same exact issue. You're trying not to over rely on any one solution when you're trying to figure out what's right for any one person. And it's really important for for somebody to come to you who really they need to take the time and understand that the first part of the process is understanding your goals, what you're trying to achieve, and what kind of constraints there are to hitting those achievements, and putting together a plan that's right given the resources that are available.
Yeah, and 100%. So, everyone just needs to keep in mind, keep a calm head. Let's sit down. Let's analyze where you're at. You might be pleasantly surprised. You just don't know until we sit down and have that conversation. Some of which is going to be uncomfortable. There's not been a time that I haven't had a client where we haven't had to have a difficult conversation. And really, that's what I do. I ask those questions, and we figure them out together, and we form a partnership for life, literally. So,
Great. Well, that's all the questions we have, Blaine. I really thank you for coming in and taking your time to answer them. You want to give your plugs, tell everybody how they can get a hold of you?
yeah, sure. So I'll actually give out my cell phone number. It's 304-216-2827. If you want to call me, if you want to email me, it's David B. Richards Jr., Jr. at gmail.com. Because we're in a regulated industry, I don't usually give brokerage information out over this type of medium. So if you want to just reach out to me, I'll happily have a conversation with you and we'll move forward.
Excellent. Thank you very much for your time. Let me sign off with our sponsors one last time. Digital On Ramp WSI, your full service digital marketing company. Pillow Sonic, the great little gift for being able to listen to audio content at night without disturbing anyone else in the room. And Fun Gifts for Everyone, a great place for novelty gifts for the whole family. You can find links to all of those companies in the description below. And I'm going to update the description with contact information for Blaine. And I really want to thank him for stepping in. And remember, we're going to be having some more talk about planning out the new year. We got some uh, financial New Year's resolutions next week. The week after, we've got planning how properly plan your New Year's resolutions. The week after that, and we got have some self care planned in January. We're going to bring some folks in who have some businesses that help you take care of yourself and make the 2022 not only your best financial year, your best year in business, but the best year for you. So keep tuning in, and we're going to keep bringing in experts to help make your life better and have you not relying on fear, uncertainty, and dread. Thanks again, and thank you again, Blade.
Thank you. Take care, Marty.